Good afternoon, everyone. My name is TJ Willits from Veolia Water Technologies, and I'll be your moderator for today's Veolia Water Tech Talk regarding the Inflation Reduction Act, understanding financial benefits and timelines for anaerobic digestion and biogas projects. Just want to get through some housekeeping items here. You should obviously be hearing me speak right now. If you're having any issues, there's two methods to listen to today's presentation. You could listen through your computer audio, through your speakers or your headphones. If there's any issues with that, you have the option of switching over to a phone call, and you'll be able to log on and listen to today's webinar over your telephone. Your microphone is automatically muted. We have several people on this broadcast, and also the webinar is being recorded, and it'll be sent to you within a day or two after the live broadcast. Though everyone is muted, we want to make this as interactive as possible. At any time throughout today's presentation, if you have a question, go ahead and enter it into the question panel. It should be on the right side of your screen. And at the end of the presentation, we should have some time to get through as many questions as possible that we get. Just want to make everyone aware that on our website, veoliawatertech.com, we have 50 or more webinars available that you can watch on demand at your leisure. So if you are interested in learning a little bit more about the various other technologies or subjects about Veolia Water Technologies, go ahead and head to our website and you can watch those at your leisure. One thing that we offer for all of our online participants on the live broadcast is a participation certificate. If you attended today's live presentation, you'll be sent a PDF certificate about a day or two after the live broadcast. So be on the look at that. Be on the lookout for that in your email box. At the end of today's webinar, you'll be sent over to a survey about today's broadcast. If you can, just go ahead and take a few moments and fill out that survey. It's only about 30 seconds or 60 seconds, but it really helps us make sure that these are of value to the people that attended. Also, just to say thank you for taking that survey. Anyone that takes the survey, we're going to enter you into a drawing to win a $25 Amazon gift card, just to say thanks for taking a few moments of your time. And to provide a little information about Veolia Water Technologies, we're a leading water and wastewater treatment company, and we support our clients through projects, technologies, and services. And you can see that those three key areas are how we make sure that our customers' water and wastewater treatment goals are constantly being met. And now to get to our technical portion of today's presentation, I'm going to introduce our two panelists for today. Our first panelist that you'll hear from, his name is Graig Rosenberger from Veolia Water Technologies. He's currently the Vice President of Light Industries. And in this role, he's responsible for managing all aspects of a client's project, everything from design to feasibility to piloting, and of course, all the way through installation and commissioning. He has over 20 years of experience in biological wastewater treatment in a broad range of industries, including food and beverage, pulp and paper, chemical, and ethanol. And also with us today is Corey Went from Baker Tilly. He's been with the firm since 2010 as a principal, and he specialized in the development, advisory, and financial support of large capital expenditures and continuous improvement project. He brings a wealth of experience from energy, industrial, and process manufacturing environments to help clients grow and manage their business using modern analytical frameworks. So at this time, I'd like to hand the webinar over to Graig Rosenberger. Graig.
Yes, thank you, TJ. And as we move forward here through our webinar presentation today, here's just a quick agenda of items that we're going to touch on. We're going to go over a little bit about the Inflation Reduction Act in the background and where it came from. And then we're really going to get down into some details of that act, who qualifies, what type of money are we talking about, how does one go about trying to have a wastewater and an anaerobic project fit into the Inflation Reduction Act and the tax credits available. We'll talk about a little bit more about actually what is a qualified biogas property, you know, some language there that we need to talk about, and when you do a project, what can be included and what is not included in the tax credits. We'll look over a little bit over the technologies that are applicable, the anaerobic technology really at the heart, and the biogas upgrading technologies, and then we'll have a little wrap up at the end of the webinar. So a little bit of background. As many of you know, the Inflation Reduction Act was passed and signed into law in August 2022. In that act, there was some significant legislation designed to increase clean energy and reduce carbon emissions. The benefit for that is that the tax credit is available for biogas projects. So most people think of these in the solar and the wind industry, but if you take biogas and you positively utilize it through a boiler, a CHP, renewable natural gas, you can qualify for those tax credits in an industrial anaerobic wastewater treatment plant. So why is this interesting to end users? Many end users are looking at wastewater treatment plants and anaerobic systems to begin with. It's a very common technology out there. There's Veolia itself has about 700 references in anaerobic around the world, over 150 references here in North America. Many industries have used anaerobic treatment, food and beverage, pulp and paper, chemical industries, biofuels industries. So this is a technology that is out there and people are putting in already just for the traditional benefits of anaerobic, of low sludge production, low chemical yield, footprint advantages. And now with the investment tax credits available, the biogas value is more than ever. So the Inflation Reduction Act and the tax credits are the key to this, and I'm going to hand the next section over to Corey, who's from Baker Tilly, as an expert in these tax credits, over a decade of experience with end users like yourself. So I'm going to turn it over to him, and he's going to go over some of the details. Corey, up to you.
Well, thank you, Greg, and thanks, TJ, for having me today. Hopefully we can shed some light on what this Inflation Reduction Act means to you all. So a little bit of background quick on Baker Tilly. Baker Tilly is a top 10 audit, tax, and advisory firm, top 10 globally. And so we represent many thousands of manufacturers, utilities, and ultimately municipalities. And so if we go back over time in terms of the roles we serve for those people, we get asked a lot, what does an accounting firm know about biogas or about these tax credits? And really, we're used to having to build infrastructure for industry that sits in a municipality or touches up against a utility district and ultimately bumps up against a user rate class for wastewater discharge in a municipality, so that we serve for the municipalities. So at the end of the day, we do know a lot of all those functional areas, and it tends to lend itself well here as we start to work through the Inflation Reduction Act and how we can use anaerobic property to generate a tax credit. So a little bit about the law, as Greg mentioned, it was signed in August, and I don't think it got much more publicity than reducing the cost of insulin for individuals and things that are kind of more residential. But buried within it was the largest single energy tax credit ever. That was initiated here, and over 200 billion or 270 billion of incentives were within it for 70 different energy types, and one of those now being biogas property. And so we think it's something that manufacturers can greatly benefit from. So a little context here. Prior to the Inflation Reduction Act, there was a number of existing credits that qualified. Particularly one, if you've done anaerobic facilities before, there was one called the biogas or biomass and trash facilities, is how it was described. And don't think of trash as garbage, but trash was more a byproduct or co-product of industry that people use to generate energy. And at that point, for those tax credits, it was always facilities using that feedstock to make biogas, which then ultimately had to make electricity. And so any of the assets that were integral to the production of electricity ultimately became eligible for the tax credit. Fast forward, greatly expanded now to all sorts of different energy types, 70 in total. And now there's a new carve out and a new qualifier for biogas property on its own. And biogas property now, for anaerobic, you can take this energy property and use the biogas to go into a boiler, go into an engine, or go into pipeline injection natural gas, known as RNG, or renewable natural gas. And so it gives you a lot of flexibility in terms of how you use this. I should say it also can go directly into fuel and fleets, downstream of pipeline injection or non-pipeline injection, just through RNG pumps at your facilities for your trucking fleets. So I think the key here is highest and best use is now available for the biogas property, however it works best for you operationally. So what is meant by a tax credit? Really, the Inflation Reduction Act is a direct offset to the federal tax liability. So it's a federal tax credit that is an entitlement. At least this biogas property is an entitlement, which means if you file for it, you earn it, and you earn it by filing a form on your tax return and effectively not paying in the federal taxes owed for the credit that you've earned. Credits come to projects in 3 different ways. Effectively, the person who owns the project when it's placed in service is the beneficiary of that tax credit. So you can use the tax credit directly against your own federal tax liability. You can carry it back 3 years and forward 22. Carrying it back is great as you look at the project and ROI, and maybe even a new facility, core processing facility with a lot of accelerated depreciation and things coming from just the core processing assets. Often doesn't have tax appetite or income in the first years due to a lot of accelerated depreciation and whatnot on your equipment. At least you can go backwards and instantly get that benefit at time 0 of the project. Also, this credit, unlike any before for the investment tax credit, it is transferable. And so effectively, you don't have to do sales leasebacks or anything complicated. If you are the owner when it's placed in service, you earn the tax credit, you then can sell to another tax-paying entity that credit, and that's a market-based transaction between you and that party, non-related party, but that party. And so effectively, the credit becomes fungible, and that means that the funds can flow within the organization as a result and help buy down the capital costs or pay for the incremental capital cost. Lastly, this tax credit does allow tax-exempt entities to participate, local governments, tribes, et cetera, people who don't pay taxes, and ultimately they can get a direct payment option for the biogas energy type or energy property. And the investment tax credit for industry, you cannot get a direct pay option. You do have to apply it to taxable income or transfer to somebody that does have it. So a little bit about how the investment tax credit works. In this case, we're talking about the investment tax credit versus production. There's also an excise tax credit that goes against gallons of fuels produced or used, which could apply for RNG. But for today, just for purposes of getting a project done, we're going to talk about the investment tax credit as the mechanism for biogas property. So that's Section 48 investment tax credit. And effectively within Section 48, there's a number of different energy properties we'll go through next that have a base credit assigned for them, a percentage value, and then that percentage value can be multiplied by 5x. Don't know why it's 5x, but it's 5x on the base credit. And you get that if you meet prevailing wage and apprenticeship requirements for the project. In addition to that base credit value, there's situational adders that are in addition to the base credit value, and that's if you're able to use domestic content, if you're able to build in an energy community. And the last one is environmental justice. So where communities weren't considered energy communities, there's still an allocated amount of credits for environmental justice that can add additional, but that's really just for small scale solar and wind. So as you read news articles or things saying, this could be up to 50 or 70%, it's because of environmental justice, but that doesn't apply to biogas. So we'll go through some examples here in a minute. So with respect to that base credit, you can see that there's a handful of base energy, base credit types. There's also a handful of the 2% credits. There's a number of other tax credits actually that exist in these base credits, but these are the ones that most closely tie to what we'll be talking about today. And again, there's production tax credits, but those exist largely for the non-biogas properties or wind or solar. So we're going to focus on the biogas property today. So, if we take a biogas property example and then add to it domestic content, you can see that the first adder has everything to do with domestic content. Domestic content is defined as two things. You must use 100% structural steel and iron in the facility itself. Anaerobic facilities won't have a lot. You aren't building huge structures usually to accommodate these things, but or buildings, I should say. And it also must have a certain threshold, an annual threshold, annually adjusted threshold of critical equipment. That is the energy property as a part of the total cost of the components and subcomponents. So in this case, if we're looking at a biogas property today, that's going to be begin construction before 2025. 40% of the components and subcomponents of the project itself, aside from structural steel, it has to be 100% must be domestic content. I'll just say right now, there is no guidance listed on the specific definition for domestic content. I've seen people say, hey, no problem, I'm American, I qualify. I wouldn't take any credence in that yet. As of today, there is no guidance that's yet out. When it's issued, it will follow previous Buy American standards or things used in the automotive industry potentially that you could be coming from 21 different countries and still considered, quote, domestic content. So stay tuned, but this should be something at the end of the day that's controllable to you. The second adder is the energy community. This has everything to do with where you are. So unless you're currently going through site selections, things like that with us, that we're helping you find those sorts of things, it's your address will be where it is, and it's binary. You will get it or won't get it. Really, at the end of the day, this is a DOE map. They too are awaiting guidance from IRS on what it means for some of these criteria, but what has been identified to date, there's about 11 criteria, and it's things like brownfield where industry used to be. It's things like economies tied to coal, oil, or natural gas that have experienced downturn in the wages in those industry or those wages in those professions reflect that in those census tracts. Or it's areas where coal mines or coal-fired units have been shut down in the prior three census, 99 forward or 2000 or 1999 forward, and so effectively then this new energy infrastructure that's being built that's displacing those gets a added benefit. Again, environmental justice does not apply here. So let's go through an example now with all those base credits and adders. You can see the base credit here is 6% on its own. That is the minimum value you would get for building an anaerobic project. So if you built a $10 million anaerobic project, you would get a 6% tax credit or a $600,000 value for doing so. Now, if you use prevailing wage and apprenticeship requirements, you get 5x or you get 30%. So you would get 10 million on that $10 million project, you would get a $3 million tax credit for ultimately using prevailing wage. Likewise, domestic content, 2%, domestic content with prevailing wage and apprenticeship requirements, you get the 5x multiplier to get to 10%. That'd be an additional million. And same with the energy community. If you're in a community and use prevailing wage and apprenticeship, you can get up to 10%. So at the end of the day, the range of possibilities are between 6 and 50% for biogas property. I would say the range of possibilities you can control are realistically between 30 and 40%. To get to 30, you can control prevailing wage. And right now, one of the other factors in this is that the law says that until guidance is issued for prevailing wage, if you've already begun construction, and if you begin construction even within 60 days of that coming out, you automatically meet the prevailing wage and apprenticeship requirements because they haven't been issued yet, and you qualify for the multipliers across the base credit, the domestic content, and the energy community. So at the end of the day, it's very reasonable to expect you can control the first 30% and or bid to your subcontractors the need for domestic content once defined. So up to 40%, I think, is very possible and within your control. So let's talk a little bit about prevailing wage apprenticeship. So effectively, guidance did come out last Wednesday, November 30th, for prevailing wage and apprenticeship guidelines. That does start the 60-day clock that you must begin construction now to not be subject to those. IRS Department of Labor has published a database that will follow and will define what prevailing wage is in your census tract for those given roles, and you will be able to see how that compares to the wages you would normally be employing on the construction of this project. Prevailing wage and apprenticeship requirements do go from construction and for ongoing repairs for the life of the tax credit. So I think people's biggest concern is that there may be currently parity in prevailing wage and union wages and non-union in many markets, just given that there was so much activity and so much competition. I think the biggest concern is, will there be enough prevailing wage or apprentices to be on your project when you need it in the the right proportions. So a lot of people right now are working to begin construction, to not have those requirements that apply, or at least have those apply at optionality, so you can bid it out however it needs to be done. And so right now, since guidance did come out on November 30th, 59 days from then is effectively January 28th that you would need to begin construction. We'll go through that in a minute, what that actually means. And then meanwhile, all these prevailing wage and apprenticeship requirements that are required are only for a megawatt or greater. And so if you're less than 1 megawatt, you are not subject to these, and you do automatically meet the prevailing wage and apprenticeship requirements, and do then get those multipliers on the base, the domestic content, and the energy community credit. So begin construction. Right now, taxpayers can use a couple different methods to establish what that means to begin construction. So first is really the physical work of a significant nature. That physical work can be performed on or off site, or by having paid or incurred 5% of or more of the total cost of the facility. It should be really the total cost of the energy property that you're filing the tax credit for. I'll say we always use, or always encourage people to use, the second test, the 5% safe harbor, because it is objective, it is measurable, you can document it. It's very knowable. The first one, we have seen people do site work, earthworks, and under audit. It is not objective if that will make an auditor comfortable that your site work alone or your physical work that has occurred has met any kind of measurable threshold. What we like to do where projects are not yet under construction, or permitting, I should say, the site isn't physically under construction, is combine the two. So we'll try to meet a 5% safe harbor using physical work performed off-site. And so if we think about biogas property, that might mean you're starting constructed steel or bolted steel tanks. You might start the tank rings off-site. You might have the gas conditioning skid or membrane systems, or those sorts of things being manufactured off-site with your vendor, and have all that physical work beginning on or before this January 28th day to prove that you've in fact incurred those 5% costs for the project. And we feel that those are very objective, measurable, and things that we've done for many years, and in the spirit of what the law is trying to do, which is really induce work to begin as soon as possible. So these tax credits can stimulate the economy, and also that you can show good intent. For both tests, those taxpayers, or you as a taxpayer, must demonstrate continuous construction. And effectively, we'll just say that it's not uncommon for you to safe harbor something now in late 2022 and go through detailed design and go out to bid and have a year or multi-year construction of a core food processing or pulp and paper facility, and ultimately then be commissioning a digester in 23 or 2024 and have that meet the spirit of continuous